With just a bit of thought and planning, you can save yourself around 10% a year in tax. And it's just using one of the most common investment vehicles out there, an ISA. Now, most people actually think of ISAs as a cash product, but they're a much better home for investments. Something that you see advertised a lot is that they're essentially just a tax-free bank account. But in reality, this isn't actually much of a benefit, as the first £1,000 of interest on your cash savings for a basic rate taxpayer, or £500 for a high rate taxpayer, is tax-free anyway. So you'd have to save quite a lot to generate that level of interest, meaning it's pretty negligible when it comes to cash. But with a stocks and shares ISA, you can invest in anything really, from funds to direct companies. And really importantly, because they're in the ISA wrapper, they'll be completely free of income tax or capital gains tax. One of the other benefits, and I suppose a drawback, depending on how you look at it, is that you can access the money whenever you need it, compared to a pension where it's locked up until 55. So it's always helpful to have both in the armoury in case life throws something unexpected at you. And it's that tax-free environment that makes ISAs such an important vehicle when growing your wealth. Whilst you will have paid income tax on the money you put into your ISA from your pay packet, when you come to access your money, it's always going to be tax-free. This is the big difference to withdrawals from pensions that are always going to be taxed at your marginal rate. It's why for wealthier individuals in particular, it's vital to have a balance of the two. So for example, if someone needed £50,000 a year in retirement and all of this came from their pension, they would pay £7,500 a year in tax. If that was split 50-50 between a pension and ISA, they'd only pay £2,500 a year in tax. You might notice that's a 10% annual difference just from basic tax planning, which you'd struggle to find in investment performance. So if you can, try to make the most of the wrappers available to you, balancing tax breaks now with tax breaks in the future for that ideal outcome. Because remember, your money really does matter.